Hello, good morning, everyone. Welcome to our webinar on UA corporate tax, focusing specifically on discussing critical aspects on recently issued free zone person guide. Just to update now that we have completed 1 year of corporate tax year. It was started for companies whose financial year started on or after 1st of June 2023. And in fact, last Friday on 31st of May 2024, 1 year has officially completed. Now, technically speaking, we are in the second year now. For ease of understanding, the law requires for companies whose financial year started on or after 1st of June 2023. So it does not really mean that it applies to all companies from that day, but the starting of financial year is important. Like a company having Jan to December as audit year, which could be tax year, then financial year starting for them will be 1st of January 2024. Right? Also, another thing that we have also crossed first registration deadline, which was on 31st of May 2024. These are two what you call tax related deadlines we have just passed. Now, today's webinar is more focused on updating the new clarifications from the corporate tax guide. So I'd like to take a moment to give you a little bit of introduction about us. Can we have the next slide, please? Right. This is briefly about Premier Brains Global. So we are roughly around now in the 13th year since incorporation. We have 5 offices in UAE, which includes 2 in Sharjah, SAF zone and mainland. Then in Ajman free zone, we have 1 license. Dubai mainland, we are in Business Bay, we are in Abu Dhabi. And in GCC, our presence is in Oman as well as in Kuwait, right now in the process of setting up in Saudi. We also are part of an international association called Audit Trust, which has offices in over 115 countries. So we can reach out to companies across the globe with that. Next slide, please. Overall, our UAE operations are handled by these are the key people. There are 5 partners in the business. I'm the managing partner of UAE office and basically more focusing on the international taxation and the advisory aspects. And then we have 2 directors with us. Vineet, who is our tax director, is going to handle even some of the some part of the session today as well. And then Moin is there. Next slide, please. So we have 4 speakers today. I'm starting the session, which will be followed by Vineet, or maybe I don't know how which team player is going to speak first. And then we are going to have Darshini and Hussein. These are the 4 speakers who are from basically main people leading in the corporate tax department, followed by their team members. Next slide, please. So I'm gonna just quickly brush through qualifying free zone person for you. What exactly was issued earlier and what are the new key clarifications which are there issued. So in my view, free zone, it sounds very nice and good. Free zone means free, but apparently free zone person is one of the area where you have to really see it very, very closely. Like the stakes are quite high. One of that is that in case you do not meet the condition, or for example, you opt to stay away from taking the option of qualifying free zone, it debars you for 4 years plus that year. So 5 years in total, you're out of the free zone. So for example, if any condition you meet this year, if you miss any condition this year and next year you want to become a free zone person, it will not work like that. So once you are disqualified, it takes you out for 5 years straight away. So let me just brush through the top 5-6 conditions which are there. First is that you have to maintain adequate substance. Adequate substance means you need to have resources. We'll talk about it later on. You have to have actual presence in the free zone. Just opening the license is not good enough. Secondly is deriving qualifying income. So qualifying income, there are certain kind of income which you can derive and still you can be a free zone person. We'll talk more about it in the rest of the slides. Thirdly, that you do not have to be a person who elects for regular corporate taxing rules. So basically what it means is even you're a free zone company, you may choose to act like a non-free zone. You might say, okay, fine, apply to me 9%. So for example, You should not have elected that by yourself. Next one is, which is very critical in my view, is transfer pricing regulations, that you have to comply with transfer pricing rule irrespective of the size of your company. So we know that 200 million turnover related minister resolution was issued, but that is about master file and other kinds of files which you have to send with your returns. However, complying with transfer pricing rules, irrespective of the size, is still required being in a free zone. So that is again a very, very critical point. And the next one is your non-qualifying revenue. So qualifying revenue, we'll talk about what qualifying revenue is in the next few slides. Now here, what it means is if you can have some non-qualifying revenue as well. However, there's a limitation on that. It cannot be more than 5% or 5 million, whichever is lower. So that's also important to take care. And the next one, which is also important, I'm sure most of the free zones are already doing, so not too much to worry about kind of a point, to maintain the audited financial statement. So it is a mandatory requirement. So if in case there are certain free zones in UAE, there are over 50 free zones overall. There are some free zones who are not asking for the audit financial statement. So what it means is that if you see yourself as a free zone person, then audit is not a matter of choice. It's a matter of compulsion. You must maintain, whether the free zone or the authority or the tax authority ask you in the return or not is another matter, but you have to maintain the audit financials. So these are the main points. Now let's talk about what are the clarification which this new guide has brought in. First is that what is a free zone? So basically, we know there are a lot of free zones, but are those free zone, is the free zone approved by the tax authorities? We don't know at the moment. So what it means is the law says that you have to check with your free zone to see if your free zone is a free zone as per corporate tax law or not. So that is something you have to check with your free zone. This is something mentioned in the guide. However, right now I have not seen any free zone specifically coming out and telling you, but this is something you need to keep in view. And other important point in this is a designated zone. A designated zone, I'm sure the people who have read the VAT law, they know what designated zones are. Those are basically the free zone which have a boundary around, which are custom controlled, like Jebel Ali free zone or Dubai Airport free zone. So that definition of VAT applies in corporate tax. So those designated zones are automatically become the designated zones for corporate tax. Right. Next important thing is about cases where the parent is in the mainland and branch office is in the free zone, or vice versa, where your parent is in the mainland, is in the free zone. Our branch is in the mainland. So overall, what guide is trying to tell you is that those will be considered separate. So basically, for example, if you are a mainland entity and have a branch office in a free zone, then branch will be considered as a permanent establishment. So that has to be looked out as a separate from a corporate tax point of view, and then you can apply the benefits of a free zone person there. Similarly, for the other way around, if your parent company is in the free zone and you have a branch in the mainland, then branch mainland becomes a permanent establishment outside the free zone. So they have to be looked separately, and then you can continue to apply the free zone benefits to your entity. Another important point, which is also clarified, is about companies in the startup phase. We know one of the requirement, if you see on the left side, second point says derives qualifying income. So a new company might not have any qualifying income at the initial stage. So what do you do? So does it mean that you have to, kind of, you are disqualified being a free zone for 4+1 5 years, or what's going to happen? So this has been clarified in the guide, which says that if you're a startup company and you're not generating any revenue also, it's fine. It's not going to disqualify you from a free zone persons. Yeah, another important point, which was there in the previous resolution as well, and also in the guide, it is mentioned that any free zone as a start a qualified free zone person unless any of the conditions are not met. So this is important that if you have a free zone company, you're automatically considered to be a qualifying free zone person unless you don't meet any conditions. So it's like either you're going to opt for regular corporate tax rate or not, or to meet conditions or not. These are the things you have to look at it at the very start. Specifically, when you're filing the return, you have to be very careful on that point. I've already explained that failure to meet any of the condition can take you out from a free zone perspective for that year plus 4 years. So 5 years, the risk is quite huge. So that's it for this slide. So I'll hand over to the next speaker from the next series of slides.
Yeah, so once again, good morning to each and everyone present in this webinar. It's a welcome step that the guide has come out, but the timing may be question mark for few organizations who have already started their tax years, specifically the ones who have July onwards, the financial year starting. Anyways, better late than never. The guide has come out and has given many clarifications. It's a comprehensive guide running into 135 pages, and we have a lot to cover and lot to speak. So as a housekeeping measure, what I would request is we will take up all the questions when the presentation ends. We may extend the presentations. So for the ones who would like to discuss few aspects, we will keep the session on, and maybe others can proceed on their other commitments. And starting with the qualifying free zone persons and the slide which is on the screen, I would just like to discuss three important aspects. One is what is not clear still is which free zone is a free zone for corporate taxes. The law says there is a separate cabinet decision around it, but that cabinet decision is not in public domain. So the FAQs and the guide says, okay, go and check with your free zones, write to them and see what they answer. So if they answer in positive, yes, we are a free zone for corporate tax purposes, then yes, that particular free zone is a free zone for corporate tax purposes. Second aspect, which is anyways clarified, is a mainland company having branch in free zone or a free zone company having branch in mainland. But what is not directly answered is a free zone company having a branch in a free zone. As the logic goes, branch does not have its separate legal identity. So if a free zone company has a branch in another free zone, then of course there will be only one free zone registered person. So in case you want to have some activities in a designated zone, you may have it by way of a branch, but not necessarily if you have something in designated zone and substance not in a designated zone, then you may qualify. So this is something where you may need some evaluation and some decision making around. And last but not the least, the disqualification. The way it is worded, if you violate the condition in year one, you are out for that particular year and the next 4 years. So there is a disqualification for 5 year period, and then you may reevaluate the position in this 5 year period and think about coming in the 6th year. One ambiguous situation has been created here is if I form a new company in a free zone in year two, the new free zone company can have the benefit 2nd year onwards. But if I restructure my existing company, then I will not be eligible to get the free zone benefit for the total period of 5. So I believe government may be looking into this situation and they may come up with a further clarity on this part. Yeah, with this, I hand over to the next speaker. Next slide, please.
Next slide, please. A very good morning to the audience. My name is Hussain Manpurawala, and I'm the UAE Manager Tax from Premier Brains. And thank you so much, Rishi and Vineet, for your lovely insights on the background as well as the key issues in respect of qualifying free zones. Now, the topic which I'm going to take up right now is the very first condition of a qualifying free zone person, which is adequate substance. Adequate substance maintenance requires the free zone person to undertake core income generating activities in the free zone or the designated zone. Now, what exactly do we mean by core income generating activities? Core income generating activities are those activities which drive the significant business value for each activity. For distribution, it may be logistics or procurement. And these should not be exclusively support activities or mostly support functions. Further, maintaining adequate substance requires the presence of adequate number of assets in the free zone. Then it requires the presence of adequate number of qualified full-time employees in the free zone. Just merely having part-time employees will not be sufficient. We'll need to have qualified full-time employees. And the free zone person will also require to be incurring adequate amount of operating expenditure. So overall, the maintenance of adequate substance is a very subjective exercise. Now, coming to the free zone guide, the free zone guide has provided ample clarifications and some key takeaways in respect of adequate substance. The first one, which I'm going to be focusing on, is related to double counting of employees. Now, if a free zone person has employees which is undertaking the procurement function, that is the purchase manager, simultaneously he might also be looking at the logistics functions. So the free zone guy says that this double counting will not be allowed, and that person will be counted only once in respect of each activity. Similar clarification has been provided by the guide in respect of non-core activities. Now, one particular example which has been provided in the guide relates to the activity of delivery. Suppose if a free zone person has around 500 employees and 20 employees undertake the distribution activity, that is the core functions, which are maybe logistics, procurement in the designated zone, and around 480 employees are undertaking delivery to the customers outside the free zone, then that itself will not make the free zone person ineligible in respect of the adequate substance requirement. Similarly, the guide has also clarified that the free zone person can undertake non-core activities outside the designated zone. Now, the third clarification which the guide provides is in respect of dual role. There are various instances wherein a person or an employee may be undertaking different functions as a part of his employment. Now, this will require a deliberation from the tax manager's point of view or the tax consultant point of view. And I think Vineet can provide some insights on this issue. Vineet, can you just
Yeah, thank you, Sen. So this will be the practical situation which all the companies would be facing because when we see the senior management or the top management, there might be the dual role. For example, there would be a sales director who would be the managing director himself, and he may also be taking some financial decisions. So that's where the treasury and financing activity also comes in play. So law at the first time, or the guide at the first instance, says double counting would not be allowed. But at the second time, there's some more deliberations to be done on the dual role. What may be possible is if there are 8 working hours in a day, and if 4 hours, theoretically speaking, if 4 hours is spent for activity one and 4 hours are spent for activity two, so that might be some answer to the double counting or a dual role. However, what the example I have just said is just the theoretical example. This has to be looked from a practical standpoint as well. So that was on the double counting and dual role. Otherwise, the way substance rules are built in, of course, we did have ESR regulations, but now with corporate tax coming in and free zone person having the free 0% corporate tax benefit, substance is something which would be looked in a very stricter sense. Okay, over to you, Hussain. Thank you.
Vinayak, would you move to the next slide, please? Now, there are certain other key takeaways which have been provided by the guide. I'll just like to share some insights, and we have provisions in respect of outsourcing of the core activities outside the free zone as well. So in that respect, the law says that if the income or activity is anything other than qualifying intellectual property, the free zone person can outsource the activity to any person located in free zone or the designated zone. Now, there has been a specific usage of the word any person. So, in our understanding, it may mean that the person who is located in the free zone may not be an incorporated free zone person itself. He may be a mainland person, but having an office in the free zone or undertaking the activities in the free zone, that may be a possibility. That has to be evaluated on a case-to-case basis given the facts of the case. Similarly, the law says that in respect of qualifying intellectual property, the outsourcing can be done to any person in the UAE or a non-related party outside the UAE. So the condition which has been put is if it is outside the UAE, it has to be to a non-related party. It cannot be to a related party. And given the fact that these conditions have to be complemented with the condition that it should be under the adequate supervision of the free zone person. We have a specific set of clarification provided by the guide in respect of what constitutes adequate supervision and how we are going to be evaluating them. And we are going to take this later on. Secondly, the adequate substance examples have been provided by the free zone guide in respect of specific activities. Firstly, in that we have the example of holding companies. If a company is rendering holding company services to its subsidiaries or its group entities, then the guide has amply clarified that the presence of board of directors in the free zone will itself constitute adequate substance being present in the state. Secondly, the guide says in respect of headquarter related services being provided to group entities, the main presence of the decision maker of the entity has to be relevant. That is, they have to be present in the free zone. The decision maker can be undertaken as, can be understood as senior management of the company, the person who drives the business of the company, who take decision in respect of the business. We may take it as the CEO or the senior managerial positions which are there in the company. And thirdly, in respect of ownership, management, and operation of ships, the guide says that the core activities of the business have to be undertaken in the free zone. The core activity in respect of ship management services may include services in respect of crew management, in respect of managing the compliances also in respect for the ships, and the other related activities for ship handling and ship management. Now, coming to the first topic which I touched upon initially, that adequate supervision has to be present if the uh, activity has been outsourced to another person. Now, the guide has properly stated the term that the entity should have mechanisms and means to observe, oversee, assess, instruct, and provide guidance in respect of supervision to be undertaken. Similarly, the guide has also stated that we need to have adequate documentation in place to substantiate the fact that, yeah, we had adequately supervised the activity being undertaken outside the free zone. How can we ensure that proper documentation is present? We can have contractual agreement with the service provider wherein the list of deliverables should be explicitly mentioned. The deliverables should be timeline. That is, we should have separate timelines as to when the deliverables are going to be completed, how as the service recipient, we are going to oversee the deliverables. So these terms should be explicitly mentioned in the contractual agreements, which the guide has amply stated that this will lead to the assessment that whether the activity has been adequately supervised by the free zone person or not. And definitely we'll have some practical insights also, which Vineet can definitely provide in this aspect. Over to you, Vineet.
Yeah, so as far as clarifications are concerned, one welcome clarification was on the outsourcing part. What the guide says, outsourcing is permitted, but it has to be in the free zone. What was not clear is if it's outsourced to a mainland entity, but the work is performed in the free zone, then what is the situation? And that's where the clarification is very much helpful. So now if a free zone company wants to outsource certain part of its work, maybe it appoints some contractors for some processing work, even though the company which has been contracted with is a mainland company, but actually the employees of that company come in the premises of the free zone company or any other free zone and perform their work, then it should be permitted. That's what the clarification gives and provides the insights into. Otherwise, I think the examples are clear and Hussein has covered it all. And last but not the least, substance is a subjective topic. Some subjectivity will always remain, so you cannot have 100% clarity on all the matters. Yeah, over to you, Hussein. Okay, Hussein, I,
Yeah,
I
Vineet.
I can take it. Yeah.
Yeah.
So next topic which we can discuss is on the ancillary activity to the qualifying activity. There were much ambiguities present, what constitutes ancillary activity, etc., etc. So when the law was revised, they provided the two major yardsticks. That is, one, it is necessary for the performance of the main activity, and second, it makes the minor contribution and is so closely related to the main activity that it should not be regarded as separate activity. Now, guide provides clarification into these sentences. So if I talk about the first circle, it says it has to be a support to the main activity rather than being the core activity itself, or it is seamlessly integrated in such a way that its absence would disrupt the main operations. And of course, the guide gives us more clarity by way of examples, which we will discuss in the subsequent slide. But when we talk about circle number two, and specifically when it says makes minor contribution, the guide clarifies that it is the assessment in relation to the term minor. It has to be based on the financial contribution. That is nothing but as a percentage of the total revenue. And second case is how close it is from the main activity that it cannot be regarded as separate activity. The guide again is silent as far as further clarifications are concerned, and it only says it would be seen on case to case basis. So that's where some subjectivity also comes in. Now we will very quickly discuss a few examples which elaborates the word ancillary. But remember one thing, these are just examples. It should not be taken in a very stricter sense. Each case would be a unique case and it has to be evaluated on case by case basis. Vinayak, next slide, please. Yeah, so the first example which we can take is of a manufacturer of the televisions. So its mainstream revenues will be sale of manufactured televisions, but along with that, it also earns revenues on installation services and extended warranty schemes. So the guidance which we provide is, in case there are some installation services and some extended warranty revenues coming in, and as far as it contributes minor, it has a minor share vis-a-vis the percentage of the mainstream revenues. In my example, I've taken 2%. Then of course it can be treated as the ancillary activity. So the moral of the story is, if you have revenues of installation services, extended warranty, etc., etc., these revenues will be treated as ancillary revenues and you need not test them for the de minimis rules. The second example which we can take is of the trading in qualifying commodities. So there's an example of a company in DMCC which trades in gold and other precious metals. But along with that, it has an ancillary revenues of ocean freight recoveries and vaulting charges recovery. So similar to the first example, the additional revenues which are flowing in, and there's an assumption that these are only 5% of the main revenues. So this might be treated as an ancillary revenue, and thus we might not test the de minimis test for this ocean freight recovery and vaulting charges. Third example which we have taken is on the shipping front, where there is a ship owner which has leased out the ship on a chartered basis. So the charter hire income becomes the mainstream revenues. And as part of the shipping industries, and the people who are here, part of the shipping industry, they may be very well aware of the words of port charges and demurrage charges. So these are part and parcel of the overall shipping operations. So even though the revenues are coming in, as far as they are making the minor contributions and are not regarded as a standalone revenues, they may also be qualified as an ancillary revenue. Next slide, please. Yeah, the fourth example which we take is on the reinsurance business. So we have taken an example of a company. You can maybe you can imagine it as a DIFC company. So the mainstream revenue would be coming in from as a premium from the reinsurance contracts. But as a subsidiary or ancillary revenue, the premium would be invested in some financial instruments, and this is very common practice in an insurance or a reinsurance scenario. So in this case also, if there are any returns from the investments of the premiums in some financial instruments such as bonds or maybe equity shares, etc., etc., these revenues would also be treated as an ancillary revenue, and thus we may not evaluate the de minimis test. Next, our last two example I've taken on the distribution activity. First is a company having the ancillary revenue or additional revenue in form of a scrap material sale. So yeah, as we understand, and as we trade, there might be some products which have lost value, or they may be broken or obsolete, etc. So we sell them in a scrap. So these revenues would also be treated as ancillary for the free zone corporate tax purposes. And maybe if you can take an example of a company which is into the sale of chemicals. So there are some chemicals which require the training for the use of it, or maybe used in a manufacturing processes. So if I have an additional income coming in from training the staff of the customers, and if I can substantiate that these revenues are nothing but parts and parcel of the mainstream revenues, or are closely associated with the mainstream revenues, then I can claim it as an ancillary revenue for the corporate tax purposes. Caveat, these are only examples. It should not be taken in a very stricter sense. Each facts should be evaluated on independent basis. Yeah, next slide, please. Okay, so I would just hand over to the next speaker to start the discussion on the qualifying activities. Yeah, Darshini, please step in.
Thank you, Rishi, Vineet, and Hussain for your valuable insights. Hello, everyone. Dashni here, Tax Manager at Premier Brains Global. So we shall now deep dive into the clarifications provided by the guide for each of the qualifying activity. The first qualifying activity is manufacturing and processing of goods. With respect to manufacturing, the guide has clarified that the activity refers not only to producing new goods, but also to improving or assembling the pre-existing components. However, it has also been clarified that repairs shall not form part of the manufacturing activity, since it involves fixing of the existing goods to its original state and does not create a new product per se. Further, the guide has clarified the term goods. The guide clarifies that goods manufactured shall be in a tangible form, for example, electronic furniture or car. It also specifically excludes intangible items such as software, which can be sold separately. However, the term good includes software which comes embedded in a hardware, since they are sold as a single unit. Further, the qualifying activity will cover both the types of manufacturing. First is full-fledged manufacturing, wherein the activity of the manufacturing of goods is conducted at the manufacturer's own risk. Second is contract or toll manufacturing, wherein the activity of manufacturing is undertaken on behalf of another person. The guide further clarifies that under contract manufacturing, the location of the contractor is irrelevant as long as the manufacturing activity is conducted within free zone. Now, the guide also mentions certain additional functions to the activity, such as packaging process and post-sale services, to be closely related to the qualifying activity and will not be considered as a separate activity. However, it is important to note that whether these additional functions can be considered as ancillary should be assessed on case-to-case basis. Now, coming to processing. Processing, as per the definition, is a wider concept as compared to manufacturing. And the guide also specifies that processing may occur even when an item undergoes a process but remains essentially the same product and no new product is created. Now it is crucial to mention one more clarification provided by the guide, which we have reproduced verbatim here. Goods manufactured in UAE need not pass through the designated zone. However, distribution activity is required to be conducted in or from a designated zone. I request our tax director Vinay to shed some light on the possible interpretation of this sentence and provide his input.
Yeah. Unfortunately, a situation again may be created when we have a manufacturing company in a free zone. And as a manufacturing company, they may obviously sell the products. So whether we treat the sale function as a distribution function or not, unfortunately, again, there is no clear clarity in the free zone guide which has come out. So maybe On case-by-case basis, this could be evaluated. And in case of much risky positions, we would recommend to take the private clarification on this point, because when the consultation draft also came out, this point was given by way of an example. And similar language we see in the corporate tax guide as well. So in the cases where you have a manufacturing setup in a free zone, which is not a designated zone, just assuming that, and you have a sale function as well. So whether that sale function would be regarded as a separate function, as a distribution function or not, is something which would be more relevant and important. So in these kind of cases, we recommend to take a formal assessment and at least approach the FTA by way of a private clarification. And the next point, very interesting and a welcome clarification, is on a contract manufacturing model. Now, this is to understand in a very simple term. There is a contract manufacturing agreement where the principal is sitting in a mainland but has contracted to a manufacturing setup in a free zone, which is a free zone company. So the free zone company, which is doing a contract manufacturing activity, would still be eligible for the free zone benefit irrespective of its principal being a mainline entity. And this is a welcome clarification again in the corporate tax guide. Okay, that's it from my side. I hand over to Darshini again.
Moving on to the next qualifying activity, which I may add is also a thought-provoking activity, trading of qualifying commodities. The decision had defined trading of qualifying commodities to mean the physical trading activity of qualifying commodity and the associated derivative trading. It had also defined the qualifying commodities as metal, minerals, energy, and agricultural commodities that are traded on a recognized commodities exchange market in raw form. Now, this definition, which was provided, had created a lot of questions as to what is meant by the term like traded on a recognized commodity exchange market, what will comprise as a recognized commodity exchange market, and what is meant by raw form. Now the guide has answered these questions. It states that trading on a recognized commodity exchange market does not mean that the trade itself needs to be performed through a recognized commodity exchange market, which I think is a quite welcome explanation given by the guide. Further, for recognized commodity exchange market itself, it has stated that any commodity exchange market which is established within UAE or outside UAE. In fact, it has also provided examples of the recognized commodity exchange market. For example, within UAE, it has provided the name of Dubai Gold and Commodities Exchange, and outside UAE, they have provided examples of Chicago Board of Trade and London Metal Exchange. However, we have to note that these are only examples, and any other recognized commodity exchange market of equal standing may also be considered. Now, coming to what is meant by raw form. The guide, aligning with the original definition, states that commodity should be in a natural and unprocessed state without any value addition once the commodity is grown, extracted, or mined. The guide also allows raw form to include commodities which have undergone minimal processing, highlighting the word minimal processing to meet the trading standards or specifications of a recognized commodity exchange market. Now, to help understand what is minimal processing, a few examples have been provided in the guide for what is considered as a raw form. Like, for example, in agricultural commodities, wheat, corn, or soybeans are assumed to be traded in the raw form after being harvested and without undergoing further process. In case of energy commodities, crude oil or natural gas, which have not been refined into other products, is said to be in raw form. Also, metal commodities such as gold or silver bars or aluminium ingots are considered as raw form before they are further processed. However, there is one sentence in the guide which states that commodities traded on a recognized commodity exchange market will be deemed to be in raw form when they meet the conditions to be traded on the said exchange. Now, one may consider that this sentence raises more questions than it answers. I again request our tax expert Vineet to please share his insights on this.
Yeah. So I think the clarifications would have got smiles on the face of the commodity traders, specifically sitting in the DMCC. Yeah, uh, much has been talked about the raw form, but less has been spoken about the minimal degree of processing. So again, it leaves the interpretation how it is as from the taxpayer's perspective and tax authority perspective. So in case there are some ambiguities, we suggest having the private clarification on this front. And very important, the last sentence or the language, the way it has been put in the corporate tax guide, it states the deeming fiction of the raw form once they meet the conditions to be traded on the recognized commodity exchange market. Now, there could be two interpretations around it. One is, of course, it's a raw form and I do a minimum processing to meet the standards of the exchanges. That is clear, that is permitted. But if I convert a raw material into another product and that product has a market or has an index on an exchange, will it be a deemed raw form or not? This is what the ambiguity comes in. Of course, there might not be a direct intention on this language, but our view is the raw form still has to be continued. In other words, if there's an iron ore, and I convert it into a steel, and even if the steel is traded on any of the commodity exchanges, that may not be permitted because steel is not a raw form, and raw form of the steel is iron ore. At the same time, if I'm drilling a crude and doing some kind of processing, uh, to have a certain grade to be traded on in exchanges, even though there's a processing involved and may not be considered to be a very minimal processing, but it still remains in its raw form, then it might be deemed as a raw form since it has been traded on the exchanges. So that's where the language creates a bit confusion. But our view is clear as the way the law stands today. Raw form cannot lose its nature. So once the raw form is out, then of course this benefit may not be available to you. Having said that, if there's some ambiguity, we would recommend to have a private clarification on this front. That's it, Darshini, from my side. You may continue.
Coming to the next qualifying activity, reinsurance services. So reinsurance services basically are activities which assume risk undertaken by another insurer or reinsurer. And such an activity is to be conducted under the oversight of a competent authority within UAE. The guide hereby clarifies that reinsurance activity includes reinsurance services, underwriting fees, actuarial services, as well as account management services. However, we shall further understand the above with an example shown on the screen. Now we can see that reinsurance FZ is incorporated in DIFC, assuming DIFC is a free zone for the purposes of example, is earning revenue from three sources. The first source being reinsurance premium received from the primary insurer, again whose location may be in free zone, UAE, mainland or a foreign country. And the underlying insured person A also may be within the free zone in UAE mainland or in a foreign country. And this activity of earning reinsurance premium as per the definition will be considered as a qualifying activity. This also further goes to show that the location of the primary insurer and that of the insured person or the insured asset or the specific insured activity is not relevant. The second stream of income is where reinsurance FZ LLC had invested the excess fund received, crucial to note, from the reinsurance premium in a portfolio of bonds and equity, etc., and is earning investment income from the same. This income may also be considered as closely related to the qualifying activity and, as Vineet has already clarified, will be an ancillary activity and to be treated as a qualifying income. The third income, however, wherein reinsurance FZ LLC is directly providing insurance services to insured person B, will not form part of the qualifying activity since it is not a reinsurance activity itself. So this is on reinsurance services. Vineet, if you may please provide some inputs from your end as well.
Yeah. I would just like to speak more on the examples which they have given for the certain stream of revenues to be treated as ancillary. Of course, in a reinsurance or a reinsurance businesses, there might come some additional services, maybe a survey services or actual services or a risk management services. Though guide, provides more light and it gives us an impression that it might be treated as an ancillary revenue. My suggestion would be to have an independent assessment on this front, because at one side we have a reinsurance premium and on other side we may have a full-fledged service department within an organization who would be doing an independent actual services as well. So in that cases, definitely it would not be treated as an ancillary services. So though there are examples to treat actual services, any add-on underwriting premiums, etc., as an ancillary income, it might not be so, looking at the facts of the case. So you might assess or reassess the positions and then take a final decision whether you are a qualifying person for the free zone or not, as far as your reinsurance business is concerned. Yeah, I hand it over to you, Dashani, with this.
I request the next speaker to please take up the slides from here onwards.
Thank you so much, Darshini. Thank you, Vineet, for your lovely inputs. And I hope the audience is having a great time enjoying the inputs and insights from the Free Zone Guide. Now, here we are addressing the elephant in the room, which is distribution of goods or materials in or from a designated zone. We know that in the UAE and all across the world, most of the businesses are engaged in buying and selling of goods, undertaking trading, undertaking manufacturing and selling. So the Free Zone Guide, prior to the publishing of the Free Zone Guide, the industry had a lot of questions. There were a lot of ambiguities whether imports will be covered as a distribution activity or not. Whether if a person is undertaking third port shipment, that is the direct transfer of goods from the supplier to the end to the customer without the goods being entering into the designated zone, whether that will be covered as a distribution activity or not. So the guide has come as a welcome clarification with a lot of insights on these pertinent issues which was affecting the industry. So let us just take upon the clarifications. What exactly is distribution? It involves the buying and selling of goods, purchase of materials, components, and items which are tangible or movable. So the guide has, so the law actually states that the goods need to be tangible, but the guide has put in a clarification in respect of certain intangibles which are embedded into a software of a hardware device. Suppose we have a smartphone, we have a mobile phone, and we have an embedded software into the mobile phone, and that is traded inside the mobile, then that will not lead to the disqualification from distribution activity. That will be squarely covered. Similar example can be taken in respect of automobile distributors, wherein they have pre-installed navigation software into the cars. If that is traded by the distributor, that will totally be sufficient for the distribution activity and will not lead to its disqualification. Secondly, the guide has come with a lot of clarifications on the entry of goods into the designated zone in respect of high sea sales and purchase from mainland. With respect to the entry of goods through DZ, the guide has clarified that this condition is only applicable in respect of import of goods. If the goods are purchased from mainland entities and they are directly sold to another mainland entity as a customer, then the guide has clarified that this will be considered as a distribution in or from a designated zone. So now we have this clarification with us that even though in respect of other than imports, the goods will not be entered into the DZ or the designated zone and they are directly sold to the mainland customer, still the distributors need not worry and they are totally qualifying the free zone conditions, subject to, of course, the other conditions being satisfied. In respect of high sea sales or third port shipments also, the guide has amply clarified that this will be considered as a distribution activity and the condition of in or from a designated zone will be satisfied. Similarly, there was a condition in the law which stated that the sale which has to be done by the distributor has got to be to a person who will resell the goods or will further process the goods in order to be resell it further. Now, this actually comes to the, comes to a very important aspect, that is satisfying the end user test. Who satisfies as the end user? End user may be stated as a person who actually consumes the good for which it has been intended. Suppose if a organization as a service industry purchases laptops from a laptop distributor or an electronics manufacturer, and then the service industry consumes, the employees of the firm consumes the laptop and uses their own for their own services, that will be said that the laptops have been consumed by the entity. So in that case, the end user test will not be satisfied. That is, it will not be stated that the entity has resold the goods. And with respect to the end user test, to satisfy that, the guide has clarified that due diligence has to be taken care of by the distributor in the form of taking KYC measures, like taking undertakings from the person to which it is selling, whether the entity, the customer, will resell the goods and will not consume it for their own use. With this, I'll ask Vineet to provide some other practical examples which the guide has taken care of in respect of distribution.
Yeah, thank you, Hussain. So, many clarifications answers the doubts which were going around for a few months, especially around the high sea sales or third port shipments. So I think the clarification would put to rest all the speculations which were around in the market. Another important thing which comes in through the language of the guide is the physical movement of the goods is not relevant. This is what it appears to be it your third port shipment, high sea sales, or the purchase from the mainland or say and sale to the mainland. But here, there is a silver lining, or I would say, the matter of fact is, if the goods are imported, they have to be imported through a designated zone. So even though you're purchasing from a mainland entity, you need to ensure that if these goods are imported, whether they have been imported through a designated zone or not. Simple example I would take. You may purchase it from your supplier based in mainland, and he has procured this goods from Oman, and the goods have entered through road. That is, they have not entered through a designated zone. So in this circumstances, whether the example would still remain good or not, it's still a question. In our opinion, if the goods are not imported, whosoever has imported it, if they are not imported through DZ, they should not be going in for this benefit. Of course, if they are not meeting the conditions, etc., etc. And in case they form very minor part of the revenues which are below the de minimis limit, then there's no problem. Otherwise, purchase and sale to the mainland, this is something where you need to keep the control on the import through a DZ conditions. And second important thing is the additional compliance which has been put in to ensure that customers are not the end users. So you might have to take some undertaking, some confirmations. Practically, what we have seen is your customer may not bother to give all these things to you. So in that case, how do you deal with it is again a practical question. So even though guide provides good amount of clarity, a couple of aspects may pose a challenge from practical standpoint. That's it from my side, Hussein. You may continue.
Yes, next slide, please, Vineet. Vinayak. Now we come to the next activity, which is there is the treasury and financing services to related parties. Now the guide has again provided some crucial insights and very welcome relaxations in respect of certain self-investment as well. Before moving to the key clarifications provided by the guide, let's just understand as to what kind of services are covered by the law in respect to treasury and financing services. The law states that services to related parties in respect of provision of cash, in respect of liquidity management, financing, and financial risk management are covered activities in this qualifying activity. Now, we may take an example if there are group entities and one is having a liquidity crisis. So one may avail a working capital loan from another headquarter or any other group entity. Or suppose one may take just a cash loan or a cash transfer or cash pooling services. Then financing transactions may involve undertaking loans for short-term purposes, long-term purposes, for asset acquisition, and financial risk management may be understood as undertaking hedging transaction for any kind of forex risk or any kind of uncertain economic risk for a related party by another related party on its own behalf. So the guide actually provides clarifications in the form of first point is self-investment has been treated as a transaction undertaken by a related party. Let us understand this with an example of an entity which is undertaking business activities and it has surplus fund available in its kitty. Now, what will it do with the surplus funds? It will invest it in some, short-term liquid assets, maybe fixed deposits, which can earn itself interest. Now, the interest income which is earned on account of that self-investment will be treated as a qualifying activity, as amply clarified by this free zone guide. So, cases wherein the entities have surplus funds available and they do not know what to do and they invest it in some short-term liquid assets earning interest income, that will be covered under the qualifying activity of treasury and financing services to related parties. So in a way, the guide has stated that self-investment will be deemed to be treated as services to a related party. Similarly, we have a clarification in respect of shareholder loans. That is, if the entity or a company has given loans to shareholders and it is earning interest on account of that loan, that will be considered as income generated from the qualifying activity of treasury and financing services. And the moot point here to be noted is there are no threshold limits which have been prescribed by the law or the guide in respect of what amount of loan has to be given or what amount of loan has not got to be given. Although, having said that, since the transaction of availing and giving loans to shareholders and other related party will be covered as a related party transaction, and there we have transfer pricing provisions kicking in, which require, as per Article 34, that the transaction has to be got to be at arm's length. That is, it should be undertaken as if it is being undertaken with an unrelated party, and the terms of the transaction has to be at arm's length, that is at fair value. The terms of the interest rate, the income streams has to be adequately being covered at arm's length. That's all from my side in this. Vineet, kindly put your inputs.
Yeah. Uh, for the audience, we might overshoot by the next 15 minutes. Please bear with us. If you have another commitments, we would be sharing across the presentations and we can connect on one-on-one basis as well for any clarifications. Coming back to the presentations, one point is the self-investments. Again, there were many questions. What do I do with the surplus funds? A common businessman would park it in a bank, earning some interest income. So the guide provides clarity on this. It says it would be treated as a transaction with related party, and then you can evaluate the qualifying activity of financing and treasury to a related party. So that's again a welcome step from the government. The important point here now is to prove the substance and of course the arm's length behavior wherein some subjectivity would come in. So definitely in the cases where you have surplus funds invested in some FDs, etc., and you are earning some interest income. So this is the point you should be looking from a practical standpoint. Over to you, Hussein, and I would just request you to be a bit faster so we can just focus on the clarifications rather than the main thing. Yeah, over to you.
Sure. We have now with us the headquarters services to related parties. We very well know that it involves services related to administering, overseeing, managing business activities of related parties, senior general management services, and other services such as captive insurance, administrative procurement, and business planning and development functions. Now, the key consideration provided by the guide to our understanding is the guide tries to focus on the centralization of various covered services, where there have been various examples provided by the free zone guide, which has again come to the moot point that all the services, all the activities undertaken by the headquarter or the regional headquarter has to be on a centralized basis. That is, the guide provides examples on relevant management decisions, strategic decisions to be undertaken to group entities. Then the guide provides examples of incurring operating expenses on behalf of group entities. Then the guide provides examples in respect of HR, tax, marketing, and other support functions which can achieve the best outcome for the group. This is in the cost optimization standpoint. That is, if the expenses are being incurred, it should be leading to a minimal outflow of cash from the group standpoint. So this will be covered under the headquarter related services. And the guide also provides, welcome clarifications in respect of technical supports being provided to related party. Similarly, it is the onus of the headquarter to prove that it is functioning as a regional and international headquarter to be eligible to be undertaken as a headquarter related services to related party. We have a key issue here that the domestic P or foreign P, that is a branch of a free zone person in the mainland or a foreign branch or vice versa, will be treated as related parties. So in a way, we can say that headquarter related services are covered already if being provided by a mainland entity to a free zone branch or a free zone entity to a mainland branch will be covered subject to the satisfaction of other conditions. Over to you, Vinit.
Yeah, so Hussain, I have only one point to say over here. Of course, there are many services being listed there. What impact or what important aspects which comes to my mind when I read the guide is you need to be actually the headquartered company. So, which it itself says there could be number of subsidiaries or more than 2 or 3 subsidiaries, and you are housing all the central functions in that free zone company. So in that case, maybe you may evaluate the headquarter services. But be it a case of only one entity and then you carve out it into a free zone and then house all the functions there, then there might be the tax authorities coming behind you and denying this headquarter related exemption or a 0%. So this is what, again, from a practical standpoint, the larger groups may evaluate, and the ones who are actually evaluating the restructuring to have this benefit. So be mindful of the fact some kind of centralization is being looked into for the headquarter services, and this services might be more relevant where you have a larger M&E group and many subsidiaries where the central functions are housed in one free zone entity. Yeah,
Right.
that's it from my side, Hussain.
Next slide, please, Vinit, Vinayak. Now we are on to the activity of holding of shares and other securities for investment purposes. The guide has provided certain clarifications in respect of cryptocurrency. So basically, at the very outset, the definition of holding shares and securities under the qualifying activity is inclusive in nature, and the guide has stated that cryptocurrency is also covered as a financial instrument or a security. So if a person is dealing in or holding a cryptocurrency, the guide has clarified that that will also be considered as a qualifying activity. Pertinent here to note is this cryptocurrency is not stated anywhere in the ministerial decision. That is the definition of holding of shares and other securities definition which has been provided by the law. It is nowhere stated, but the guide has provided an additional input and has clarified by way of this guide. Secondly, we have that investment purposes should not include active trading. If a person is engaged in active trading of securities and shares, then that will not be covered as a qualifying activity. Similarly, there has to be an intention of the trade of the person or the entity to hold the shares for 12 months, or the actual holding of shares of 12 months is important. Now, how do we satisfy this condition of the intention being of 12 months or more holding? Is by way of adequate documentary evidence, by way of the conduct of the business. That is, if it has been historically holding the investments for pure investment appreciation purposes for long-term period, which is generally going on for more than 12 months, that can be substantiated. And we will definitely have documentary evidence in the form of contract notes, in the form of agreements in respect of share sale, share purchase, which can very well give indication on the fact that we have the intention of holding the investment for 12 months or more. Thirdly, the guide has also provided a clarification that if the transaction has been of share and securities purchase sale has been undertaken on a recognized stock exchange, then it will be deemed that it is not undertaken with a natural person. We will recollect the law which states that any transaction with a natural person in respect of qualifying activities also will not be considered as a qualifying activity. In fact, it will be considered as an excluded activity. But the guide has stated adequately that if the transaction of share sale and securities purchase sale has been undertaken on a recognized stock exchange, then it will be deemed that it has not been undertaken with a natural person, and hence it will not be considered as an excluded activity. Over to you, Vinit.
Yeah, I have no further comments. I think it's straightforward. You can proceed.
Okay. Next slide, Vinayak. We are here with the ownership, management, and operation of ship as a qualifying activity. It is a very industry-specific activity, and there are welcome clarifications for the ship industry people who might be attending this seminar. First of all, we may recollect the law which is stated, which is the activities of offshore oil fields and maritime services are included in the ship management and operation of ships activity. Then we have marine operations, we have towing activities and general assistance at sea. Then the activity of dredging activity at sea is also covered. And last but not the least, leasing and chartering of ships on bareboat basis used in the international transportation of passengers, goods, or livestock is covered as a activity for this ship management. Point to be noted here is the exclusions. That is, the law states that the ships which are used for the local transportation of passengers will not be covered because the word international transportation has been used in the law. Similarly, if there are entities who are rendering services of yachts or leisure boats or recreation purposes ships, then those are also not covered in the qualifying activity. Similarly, if the entity is under a restaurant business and it has flotels or floating hotels and restaurants and casinos, these will also not be covered as a qualifying activity. Key clarifications provided by the free zone guide is in respect of the definition of ship. It has been clarified that the normal definition of ship will go beyond and it will include boats, example tugboats and barges as well. And the guide has provided ample clarification with respect to management of ship services. It has stated that if the company is undertaking the services of ownership, management, and operations of the ships in the way of by way of managing the crew of the ship, providing compliance services or licensing services, and other related activities, these activities will also be covered under the qualifying activity and will make a person eligible for this free zone benefits, subject to the satisfaction of other conditions as well. Vinit, kindly provide your inputs.
Yeah. So thank you, Hussain. There's only one point which I would like to state here is shipping operations for the free zone tax purposes needs to be looked beyond the transportation of goods, human beings, and livestock in the international waters. So that's what, a greater amount of clarification has been provided through the guide. So there are many more operations being covered under the ship ownership, management, and operations. Each case again would be a specific case. So in case you want to evaluate the benefit, definitely you should be looking into the more clarification which has been provided by the guide. Over to you, Sen.
I'll request Darshini, who is the next speaker, to take over. Darshini, over to you.
Thank you so much once again, Hussain, for your explanation to the various activities. Okay, so due to the timing issue, we'll just quickly brush through logistic services. So logistic services were defined to be storage and transportation of goods and materials. Now the guide also clarifies that the logistic services does not include movement of people. And further clarity, can we gain from the example itself? So in the example, logistics FZCO provides services in the form of transportation of goods and material, warehousing services. To be noted, the warehouse is located within a free zone, order fulfillment services, and freight forwarding services. Now the guide clarifies that all the services shall come under the ambit of logistics services. It is also crucial to mention that while providing these services, logistics FZCO does not take any title to the goods, and the location of the customers of FZCO is immaterial. and major of the logistics services will be provided by the logistics FGCO within the free zone. However, the last mile delivery services are provided to the customers outside the UAE free zone, that is within UAE mainland or in foreign countries as well. Now, the guide has provided a welcome clarification in this regard, stating that the last mile delivery services outside of the free zone in UAE or in a foreign country will still form part of the qualifying activity of logistics FGCO. So on logistics, this is on logistics services. Vineet, if you may please provide some further inputs.
No, I think it's straightforward. Very welcome clarification on the last mile delivery. Even though in the logistics business, last mile delivery is deemed very important, the law, it appears law to be soft enough on this front. Over to you, Darshini.
So true. So next topic is immovable property. The definition of immovable property has already been provided to us in the previous decisions. The guide further clarifies, however, that the immovable property will not include movable constructions like construction sites and temporary structures. The guide has also provided crucial inputs for property located in a free zone and a mixed use in nature, wherein the component of commercial as well as residential is involved. Firstly, it has given example of a residential building which is located in a free zone. It has been clarified that income from the retail space of the building shall be subjected to 0% of corporate tax and the residential apartments shall be subjected to 9% corporate tax. Also, example of hotel buildings located in a free zone, it has been clarified that income from retail outlets and restaurants shall be subjected to 0% corporate tax and rooms, conference rooms and banquet halls shall be subjected to 9% corporate tax. Now for the mixed use property, the revenue allocation mechanism has also been defined in the guide. The guide prescribes three allocation mechanisms which is evident from their examples. One is the direct allocation method, wherein the rent for the commercial versus the residential portion may already be fixed in the agreement itself. And the second is the indirect allocation. Now that may be based on the respective flow space utilized by the commercial component or the residential component of the property. The guide also gives other method wherein the based on the market conditions and property characteristics, you may decide the allocation on your own, which may be utilized if the first two methods are not practical to be used. Now, with respect to the immovable property portion, Vineet, if you may please provide some further input.
Yeah, so I think I do not have much to speak about on the immovable property aspects. The intention of the writing on the wall has been clear from day one. The economy which thrives on the real estate and the tourism, I think they would like to tax those entities when it comes to maybe restaurants, because they're dealing with natural persons, or the hotels which provides the accommodation, and the the real estate, the leasing part, which are there in the mainland. So I believe the intention is to tax, and this is what has been reflected. But one important clarification is on the mixed use property, which has some commercial units and the accommodation units, specifically in an hotel situation when they have conference houses or the retail spaces, etc., etc. So some amount of restructuring can be done on this front. And that's it from my side.
Okay, finally, let's cover the other miscellaneous aspects mentioned in the guide. So, it has been mentioned with respect to the taxable income, wherein the income is other than the qualifying income and is subjected to 9% of corporate tax. For that income, routine city provisions shall apply, and you may take benefit of exemption, you may take benefit of tax laws and deductions with respect to computation. Second is beneficial recipient. In case of a transaction with other than free zone person, additional documentation is to be maintained to ensure the beneficial recipient test is fulfilled. Transfer pricing. Now transfer pricing, it's already very well known that all the related party transactions are to be at arm's length, and the transfer pricing documentation is to be maintained when the thresholds cross. With respect to record keeping, no separate financial statements for the qualifying income is to be maintained, which is a good clarification. And further, but however, you have to maintain sufficient documentation for such qualifying income calculation. Now, the last point is the expense allocation, which the guide has already amply provided the guidance on this aspect as well. So we shall not repeat the whole thing further. So on the other aspects, Vineet, if you may please provide us your inputs. Vineet, you are on mute right now.
Yeah, sorry. So yeah, it's pretty much straightforward, and I think since we have already overshot, we should proceed. And let's conclude this presentation. Rishi, if you're around, maybe you can touch base on the last slide, and then we can take some Q&A. People who would like to stay on to ask some questions, we would be continuing. Others, if you have pre-committed commitments, you may leave the webinar. We would be sharing the slides with you. Yeah, over to you, Rishi.
Right. Thanks, Vineet. Thanks, Darshini and Hussein. Wonderful presentation, quite informative. Thank you for that. Let's go to the next one, Vinayak. Right. So the action plan is quite clear and simple. I think what you need to do, check your registration deadline, that your registration is been taken care of, because penalty is 10,000. Should you don't want to pay that much money at the start, so take care of that. Secondly, very important is the transition provision planning. Basically, if you are having your audited report signed for the last year, and when you enter to the tax year, it's very important that the closing balance sheet needs to be at arm's length. That's a critical point. I think your tax consultant, whoever you advising you, should be able to throw more light on that. Take that very seriously, because that closing balance sheet will become the opening balance sheet for your next tax year. So it's a very, very critical point to evaluate. And thirdly, determining the tax rate, whether you want to go into a free zone or not free zone, is something you have to evaluate. Just taking a decision to go to a free zone is not good enough. What is important to see whether you can qualify as a free zone or not. So all that conditions of substance and qualifying income, the minimus, all those conditions have to be looked more specific. And I would simply say is that it's easy to be in mainland from a corporate tax point of view, but it's more difficult uh, to comply with the condition of a free zone. So when you are a free zone entity, your duty of care is at the top of the range. So be very, very careful about that. That's what I want to say here. And then that's about the immediate action. And secondly, about the action during the year, system readiness is very important, whether you are able to throw those reports out. Are you able to take those provisions in the book? So people who in the auditing side, they have to see whether they are able to book those deferred taxes, asset and liabilities in the books if they're doing monthly closing, because that will reflect in the audit report at the end of the year, has to be taken up. Another thing is about your tax grouping, whether you want to group, whether you can group, whether you want to group, both are the important questions. So evaluate, that's very important. What's the pros and cons? A lot of advantages, a lot of disadvantages. What it can change from a company to company. Check at that. Action before compliances, updating of the benchmarking. So basically, as we discussed, transfer pricing is a new concept in the region. However, it is one of the very internationally prevalent concept across the world. But it takes a lot of due care, because benchmarking can be internal, can be external, but has to be properly done and documented. So have a corporate, have a policy around transfer pricing, have a corporate tax policy as well, for the guidance of accountants and the managers who are going to take up transactions. So as a company, we can help in all these phases, as and when, wherever you feel there is some kind of a weakness, you feel free to talk to us, and we are happy to engage and assist. And the third one is about phase two, which is the compliances, tax return filing. So that's within 9 years from end of your tax year, and the transfer pricing documentation. in the proper way. These are some very, very important one, and I think you have to plan way ahead of time and do not wait on the Excel sheets to throw those numbers to you, because once you file it, it is documented and it's given to the authorities. So be very careful. These are two phases, and we're happy to help and engage if you need at any point. That's all from my side. I think, Vinit, let's go to the Q&A and see. We have few questions here, so you can take it up.
Yeah, so we will be taking up very quickly. First question I'll take from Evelyn. Evelyn, if you're around, your question is FD interest exempt or will be qualifying income? I believe your question has come up from the surplus investment, which we just spoke about. It will not be considered as exempt income. It can be treated as a qualifying income under the treasury and financing function to the related party. So you need to have some compliances and arm's length behavior on that front. Your follow-on question is, how can we find the ALP for the managerial remuneration? To be very honest, this area is very subjective. You may not have any definite answer around it. Uh, Applying some methods, we may still arrive at the arm's length remuneration. One fit case would be looking at the past remunerations which the person has been drawing since several years when there were no corporate taxes. So that can be a good benchmark to continue. Otherwise, you may rely on some findings of some HR consulting which are available freely on the public domain. I'm using the word which are available freely in the public domain. I'm not using the word the HR report, which is very private report. A private report is definitely not considered to be a good report from transfer pricing angle. And of course, overall scheme of benchmarking, if you have an overall benchmarking in place, your margins are aligned with the margins of your comparable companies, then automatically you can club your managerial remuneration under the combined transaction approach and substantiate the arm's length nature of that remuneration. I hope we answered your question. Next question we'll take is from Kushal. Kushal, if you're around, your question is, can diamond be regarded as a qualifying commodity given its status as a mineral and trading presence on Dubai Diamond Exchange, a recognized commodity exchange? Kushal, definitely it can be evaluated, but yeah, diamond needs to be in its raw form. There are various kind of processing involved, if I understand the diamond industry in a very good sense. If it's a raw cut diamond and minimum amount of processing involved, and you have an index for that processed diamond, which is very minimum processing involvement, then definitely yes. But then if you cut and polish it for the consumers, etc., and it has changing its status from a raw form to a modified form, then it might not be available. Ajay Kumar, if you're around, your first question is, under substance, no double counting of employees are provided. However, in ESR, we were double counting as the full potential of one employee can be utilized only in one SIGA. Does not it seem some error on logical part to arrive at this conclusion? Ajay, to be honest, double counting would mean, in very simple terms, if you are doing two functions in a day, and if you have a working hour of 8 hours, then possibly you may say 2 hours I was working for activity 1 and 6 hours for activity 2. In ESR law also, wherever we have done the assessment, we have not taken 8 hours plus 8 hours. We have broken the 8 hours into further segregations. So this is how you need to see. And law, of course, is aligned with the principles of naturality, I would say. So I don't see any error in the guide coming in. Your follow-on question is how both conditions, that is beneficial recipient and end user, can be ensured simultaneously. Under a trade transactions from qualifying free zone to another qualifying being sale of goods on high C sale basis, where both qualifying are trading concerned. Ajay, in this case, you need to see which bucket do you fall, because there are two buckets. One bucket is on free zone to free zone transaction, where there is a concept of beneficial recipient, and second bucket is on free zone to non-free zone transactions. So in your example, I think you're talking about free zone to free zone transaction, wherein only beneficial recipient test needs to be passed. You need not see the end user criteria. So these are mutually exclusive events. So depending upon which bucket your transaction is following, either beneficial recipient test would be applicable or the end user test would be applicable. They will not be both simultaneously looked into. There's one more question from Ajay. Okay, there are two more questions, three more questions rather. I would take first is what is meaning of oneself in treasury and financing function? If it includes qualifying free zone person itself, then investment in term deposit with bank can be considered exempt. See, law, why it is a deeming fiction of a related party to be yourself. You understand one thing, when you are placing something in a deposit, you just think from an arm's length perspective or a third party situation. What would a third party do when he has a surplus funds? Obviously, he will make some investments. So that is what the arm's length behavior is. And the reason for deeming it as a related party is to give you a benefit, understanding the fact that the companies may have a surplus funds for 1 month, 2 month, 3 month, or for 6 months, which they intend to reinvest in the business. So they do not need to declare dividends, take it in their personal account and reinvest in the company. So to avoid that, as a treasury function, even a treasury manager would do this. It will park the surplus funds in an FD or any other money market instruments to give the benefit, or the law says you do not lose the benefit when you park the surplus funds, and that's why this deeming fiction of related party came in picture. So it has to be looked into from that angle. Of course, it can go more technical in nature. We can discuss this on one-on-one basis if you wish to engage with us. Not of course on the fee front. Engage with us only on one-to-one conversation. Next question is, for a qualifying free zone person, is revenue from dividend which is exempt under participation exemption shall be excluded for determining de minimis? Again, the same question. There could be two situations. Either you go for a participatory exemption, or you may go for a qualifying free zone person on a holding company activity. If you're going for a holding company activity, anyways, dividends are a qualifying income. But assumingly you are not a holding company, then you may look into the participatory exemption route. And of course, if it's not falling under a income which is subject to tax at 9%, the dividends may come as a trigger to lose the qualifying free zone status. We need to deep dive into the more facts into the case to explain it to you in a better sense. Though investments in corporate bonds is considered under other securities under holding of shares, is investment in term deposit also included under this activity? As the language says, it may not be included on the fixed deposit front, because one benefit they have already given is the deeming fiction of related party. So you may looked into from that angle, of course, staying within the category of treasury and financing function to related party. Otherwise, you may not see it under the holding company route. You may see it under the treasury and financing route. That comes to the end of the questions. We still have more questions in the chat box. Okay, there are more questions. Mr. Chandrasekhar Gauri, sorry, Miss Gauri, if you're present, your question was, do we need to prepare separate financials if head office is located in mainland and branch in free zone? This has been clarified. Financial statements would be at company level only and not at branch level, but you may have to keep some additional documentation to prove your calculation for the free zone qualifying income. Okay, Mr. Ajay, I think this question has been answered. Repeat it here. Rahul, there is a question, is free zone to free zone sales not taxable? Also, if entity in free zone and has only two staff, including the owner, will it fulfill adequate substance? There is no related entity onshore, just only the free zone. Definitely, free zone to free zone transactions will fall under bucket number one, where you need to see the beneficial recipient test. Having two staff, three staff, 10 staff is again matter of discussion, matter of debate. I do not have clear answer at this time, at this moment. We can engage one-on-one on this front. Mr. Ajay's question has been answered. Ms. Gauri, say majority of staffs, sales, finance, HR based in mainland, but operation is undertaken in free zone. How it would be viewed from a SIGA perspective? Definitely, if you're a trading organization, your sales staffs has to be in the free zone. Your finance and HR staff can continue in the mainland because these are non-core activities. Next question from Akash Gupta. If we consider the beneficial recipient, the buyer should be the beneficial recipient. If there is a trader of diamond in free zone and he sells another free zone person, In this case, how can buyer be beneficial recipient in case of diamond or other? See, the concept of beneficial recipient is very simple. That if an entity is a beneficial recipient of the goods, the risk of that trade or the risk of that contract should be sitting with that recipient. This is what a beneficial recipient or beneficial ownership test in a taxation angle means. How to prove it? Again, it becomes very subjective. We can engage on one-to-one discussion on that because it is too technical in nature. Next question. Customer processing the product supplied and selling after processing, that is iron ore to steel. Can we say customer is not the end user? I think this question is actually not clear. I may not be able to take it. Very sorry for that. Mr. Sanjeev Jain, your question is it exempted uh, for a free zone company for income on FD? I think this has been answered. Mr. Siddhant Mehta, your question is if goods are imported in mainland and subsequently sold to DZ and then resold to mainland outside the country, then profit earned by DZ company will consider to be qualifying income. It looks yes, but yeah, we need to see how the goods were imported by the mainland company, whether they entered through a DZ or not. Otherwise, it should look fine. Bhautik, your question is for trading in qualifying commodity, movement of goods is required or not? Definitely, it is not that relevant. It can be high C sales as well. Sandeep Jain, income of FD, this has been answered. Bhautik, your question again. Let's say DMCC company sale qualifying commodity to LLC company, but movement of good is from mainland to mainland. Still, yeah, it should be in a qualifying commodity trade transaction. Again, the movement of goods is not relevant. What is relevant is it should be a qualifying commodity and a raw form. And of course, there has to be an index on the recognized commodity exchange. For trading in, okay, this has been answered. Junaid is just saying thank you. Thank you very much. Okay. I think all the questions have been answered now. For the ones, if you feel they are not been answered appropriately, you may engage with us on one-to-one basis. So with this, we would just like to end the presentation and this webinar. Thank you for being patient and apologies for overshooting. We had a lot to cover, so we did not want to miss anything. Thank you very much. And thank you to the team, everyone present here. You have been a great presenter as well.
Thank you. Thank you, everyone. Take care. Bye-bye.